Minneapolis Fed President Neel Kashkari was on Squawk Box this morning, and he weighed in on the expected December Fed rate hike.
I mean, I think you would like knowing you'd maybe do December and stop, right?
I wrote an op-ed 6 weeks ago saying we should pause right now. Just
really?
I want to wait.
You still feel that way?
I do.
We should note that Kashkari is not a voting member on the central bank's policy-making committee this year or next, but joining us now to discuss the Fed's next move is CNBC contributor Peter Boockvar from the Bleakley Advisory Group. Peter, good afternoon to you. Great to see you as always. Do you agree with Mr. Kashkari?
So Mr. Kashkari voted in 2017 and dissented every time the Fed wanted to raise interest rates. So according to him, the Fed funds rate should still be at a range of 0.5 to 0.75. So he's uber dovish. So him saying now that they shouldn't raise, well, he hasn't voted for one rate hike. I think it's a very tricky situation because I'm pretty confident how this ends. The Fed has only accomplished 20% of the time a soft landing since World War II. So the odds of them creating another soft landing is very difficult. So if you believe that at some point we're going to have a recession in the next year or two, well, I would rather have that and go into it with a Fed funds rate at 3-ish than 2-ish. Because 2-ish gets you to be like Japan, and you get stuck and you have very little ammunition to deal with any downturns that will inevitably come our way.
I mean, that sounds painful. So you want them to raise interest rates into a slowing economy so they have more ammunition to cut interest rates when we actually do see a recession?
Well, again, it's a very difficult situation because the Fed funds rate on a real basis is only 0. I don't think that's a healthy long-term situation. Now, we're obviously the last 10 years and even in the mid-2000s are used to negative real interest rates. So it is threading a needle here. But if they stop here at 2% or they go to 2.25%, it's not going to stop the next recession from occurring. So again, it gets to my point where I'd rather go into that next recession with the Fed funds rate at a higher level. Now, whether they raise in December or not is irrelevant to me because they have every opportunity in 2019 to raise interest rates. I just feel like over time, real interest rates should be positive, and that while that may be painful to an economy that is extremely interest rate dependent and interest rate sensitive, over time that's a better foundation for economic growth.
Peter, what do you expect to happen in some of the rest of the world's developed markets next year relative to expectations? Because will that influence whether the Fed has more cover or less cover with its own policy?
Well, with emerging markets, I think the Fed being close to the end of this rate hiking cycle, it's not going to be dollar helpful. And if you get weakness in the dollar, that would be bullish, or at least not a negative for emerging markets. I think what happens with Europe is going to be very dependent on where do sovereign interest rates go when the ECB is done with their quantitative easing purchases at year-end, notwithstanding the reinvestments. And China is going to slow regardless of what happens with tariffs or anything else because they're in a deleveraging cycle and their economy is just naturally slowing right now because of the excesses that they've experienced over the last few years.